What's up guys? In this video I'm going to take a very quick look at what options trading is and how you can go about trading options. Now, if it's of interest as a result of watching this video, I would definitely recommend doing more research, checking out other YouTube videos in terms of strategies, things like that. Okay, so the one-liner, what is options trading? Well, an option is the opportunity to buy or sell a share at some point in future. That's it. To buy or sell a share at some point in future. Best way to look at this is actually an illustration. Okay, let's say we are looking at Google shares. Let's say it's March 22 right now. Let's say we think the share price is going to go up over the next 6 months by about 30% at least. You can, scenario one, buy Google shares. Let's say our budget is $300, current price is $100, we will buy 3 shares, $300 total cost. Let's ignore the trading costs to keep the illustration simple. Okay. The alternative, scenario 2, is that we look at an option. If we think the share price is going to go up, we're going to buy a call option. We think the share price is going to go down, we buy a put option. So we think price is going up, we'll buy a call option. Number 2, we think the share price is going to go up over 6 months. So we have to select the period of time for which the option is alive, i.e. before it expires, right? So we are going to set the expiry of the option to September 22, given that in our example it's March 22, that gives us 6 months for the option to do its stuff, okay? So again, recapping, call option, expiry 6 months worth, September 22. Now, the third thing is, what's the strike price? What's the price at which you potentially would look to buy or trade this option? Now, it's currently $100. Rather than setting a strike price of $100, where we have to pay a premium, the commission for the option, which in this illustration, we're going to say is $20. We are going to look at the $110 strike price. So it's $10 above, because that strike price has a premium of only $3. So $100 premium is $20, $110 strike price, premium is only $3. Why is it so much less? Because you're taking on risk. Because the current share price is only $100 a share and you're taking on risk, so the premium becomes less, okay? And because I'm creating an illustration. So recapping, call option, expiry September 22, strike price, the price at which we can execute, 110. The premium for that strike price is $3. Now, a really important point, when you buy an option, one option, that option contract actually has 100 shares in it. Okay, when you see the premium price of $3 or whatever it is, that's the price per share. So when you buy one option at a premium of $3, you're actually buying 100 shares, the right to 100 shares at $3. So the total cost is $300. Isn't that convenient? $300 buying the Google shares, $300 on one option. So we can do a nice comparison here. Okay, so in our illustration, it's now August 22. You've got 4 weeks before the expiry of your options contract, and the Google price has gone up to $130. In scenario 1, where you bought the Google shares, your Google shares are worth $100 to $130, 3 times $390. You made a profit of $90, a paper profit of $90 on $300. Okay, in scenario 2, you have an option, a call option, and you have a strike price of 110. Current price is 130. So basically, there's a paper profit, a paper opportunity profit of 130 current price minus the strike price of 110. That's $20 minus the price for each premium on the share, which was $3. So in each share, you've made $17. And remember, in one options contract, there are 100 shares. So you've made $17 times 100 shares, $1,700 versus $90 if you just bought the shares. Total cost in both scenarios was $300, $90 versus $1,700. That is why options trading is so appealing to people, because you are massively leveraging your opportunity to make profit. And just to be clear, on the option, if you actually want to realize that $1,700, so rather than actually executing, i.e. buying those 100 shares, remember you only own the option 2. You can sell that option to someone else. So they buy the shares. You're trading the option. You bought an option, now you sell that option. Now, the reason you may want to consider that is because if you actually executing means that rather than just buying and then selling the option itself, you execute and buy the 100 shares you're entitled to at a strike price of 110. That means that while you have a paper profit of $1,700, you've had to put out $110 for each share of 100 shares, $11,000 if you execute. Really important point. So in most cases, you don't want to execute the trade and buy the actual shares. You want to sell the option back and just realize the profit as a result of the premium going from $3 to $20. Really important point there. Now, let's say in an alternative scenario here, the share price of Google goes down by $10. So we bought at $100 and we bought an option at 110 strike, and it's August 22 and the Google price is $90. Now, if you bought the shares, you would be seeing a paper loss of $30. If you bought an option, given that the expiry is only 4 weeks away, remember it's August 22, the reality is that premium that you paid of $3 is likely to be much, much less because there's only 4 weeks to go. You have a strike price of 110 and the current price is 90. If the premium was $3 when it was 100 with 6 months to go, you've only got 4 weeks to go and you've got to make up $20 worth of gap now. So that premium is likely to be tiny. Like instead of $3, it could be 30 cents, 20 cents, 50 cents, something like that. So what that means is if you are now getting nervous and just want to sell that option back, you paid $3 and now you're going to sell it for 30 cents. That means you have made a 90% loss. So out of your $300, you're only going to get $30 back. And that's why it's such a massive leverage play and could be incredibly profitable, but mean that a lot of the time you lose virtually all of your money as well. And it's in theory as simple as that the whole point is it's a massive leverage play. And so why people get caught out with options is that they take expiries which are too aggressive, selecting only maybe 2 to 3 months, something like that. And they set strike prices which are really, really high because it means the premium is much lower. Okay, so if you're really aggressive with your options, sure, if things go crazy and there is a short squeeze or the share price increases 100% in a day, you will make a huge amount of money on an option. But there's a much more likely chance you're just going to lose it all because nothing dramatic happens. Okay, so if you are looking at options, I would only suggest that you look at something initially which is much less aggressive. So maybe a longer window of time with a lower strike price. That means your premium is going to be much higher, but it does mean that there's going to be less risk in it as well. And I would also obviously suggest that you start with something which is smaller, because remember that premium is times 100 shares. You don't want to lose all your money on one trade. As I said right at the beginning though, do more research. If this makes sense to you, if it's something you want to try, do more research. Watch the more detailed videos as well on options trading. Anyway, hope you found this useful. Please do leave a like, a comment, and please do subscribe. I'm planning on making more videos all around finance, investments, things like that. Leave a comment, let me know what kind of video you might be interested in. Hope you really enjoyed this video, and thanks for watching.